Welcome to this comprehensive tutorial on building interest rate curves from scratch. Let's start with the basics. An interest rate curve, also known as a yield curve, is a graphical representation showing the relationship between interest rates and different maturities for debt instruments like bonds. It provides vital insight into the cost of borrowing across various time horizons. For example, the yield curve shows how much interest you earn or pay for lending or borrowing money for a short term or long term periods. So why is the interest rate curve important in finance? Interest rate curves are crucial for pricing fixed income securities and derivatives, measuring and managing rate risk, conducting monetary policies and analysis, valuing loans and mortgages, and setting discount rates for investment decisions. Risk managers rely on yield curves to understand how future interest rates and market dynamics impact financial portfolios. There are three types of interest rate curves. The one for the first one is called the zero coupon curve. Represents yield on zero coupon bonds, which pay no coupon, but only a lump sum amount at maturity. It reflects pure discount rates for each maturity. The second type is called the par yield curve. This shows yields on bonds priced at par value, with coupon payments equal to the prevailing market rate. The next and the last type, which we're going to discuss right now, is the forward rate curve. Depicts the market's expected future interest rates implied by current spot rates. Now that we understood the types of interest rate curves, now let's look into building an interest rate curve. To build an interest rate curve, we rely on market instruments with known prices and yields. Common instruments include treasury bills. These are short-term government securities, so almost risk-free. The next ones are government bonds. These are longer-term fixed income securities issued by the government. The next ones are LIBOR rates, which are also called London Interbank Offered Rate, formerly a benchmark for short-term rates. The next ones are the swaps, which are interest rate swap contracts exchanging fixed and floating interest rates. The next one are OIS rates, which are overnight index swaps, reflecting the overnight borrowing rate. For curve building, we assume market data such as quoted interest rates or prices, settlement dates and maturity dates, coupon payment schedules, day count, conventions, and compounding frequencies. Now let us understand the construction process of an interest rate curve. Here is how we build an interest rate curve. First, we select the market instruments. We choose instruments spanning different maturities. For short term, we choose 1 month treasury bill to long term instruments like 10-year-old government bonds or swaps. Then we bootstrap these instruments. Using the price or yields of these instruments, we subsequently derive zero coupon rates. The basic idea is to start with the short maturities where data is direct, then use those to back out rates for longer maturities. Next, we handle overlaps and missing data. Market instruments may not cover every single maturity. We use interpolation to estimate rates between known points and extrapolation to infer rates beyond the longest observed maturity. Now let us look into a small example to understand the building of an interest rate curve. To understand the construction of interest rate curves better, let us look at a small example. Here, we picked instruments across different maturities: a 1 month treasury bill, a 3 month treasury bill, a 6 month treasury bill, 1 year government bond, 2 year government bond, 3 year swap. Maturity of each of them is 1 month, 2 months, 6 month, 1 year respectively. And the price for the 1 month or and the quoted yield for the 1 month treasury bill is 5%, which is also called the zero rate for the 1 month treasury bill. And the zero rate for the 3 month treasury bill is 5.20%. And the zero rate for 6 month treasury bill is 5.40%. And the price for 1 year government bond is 99 rupees, and the price for 2 year government bond is 98.50 rupees. And the swap or the fixed rate for the 3 year swap contract is 4%. The coupon rate for the 1 year government bond is 2%, and the coupon rate for The 2-year government bond is 3%. And all the payments of the bonds and the swap contracts are annual. Assuming this is our instrument pick, let us try to build an interest rate. We already know the zero rates or the yields per 1 month treasury bill, 6 month treasury bill, and 3 month treasury bill. So we want to extract a curve from this data. And this curve is a plot between the yields and the maturities of the instruments. So let us write a small table here, which is the data which we need to build the curves. So in this table, we can see that we already know the zero rates for 1 month treasury bill, 2 months treasury bill, and 6 months treasury bill. We have to find the zero rates for 1 year government bond, 2-year government bond, and 3 year swap. For a 1 year government bond, we can say that the price is equals to coupon, or coupon here refers to the overall coupon payments which we get from the government bond into discount factor plus principal or the face value of the bond into discount factor, which so the price of the 1 year government bond is 99. So 99 is equals to the coupon rate is 2%. And 2% of 100 is equals to 2. So, and the bond is for only 1 year. So here the coupon is 2 into TF plus the principal is 100 into TF, which we can write as 2 plus 100 TF. From this, we can find the value of TF for 1 year, which is equals to 0.97059. Now, the formula for the zero rate from DF or the discount factor can be given as 0.8 at time t is equals to 1 by TF at time t by 1 by to the power of 1 by t minus 1. So here R0 at time 1 year is equals to 1 by 0.97059 to the power of 1 by 1 minus 1, which will be equal to somewhere around 3.03%. So the zero rate for 1 year bond which you calculated is 3.03%. Now, in the same way, if we calculate the zero rate for the 2 year bond, 2 year government bond, we get the value as 3.90%. Now, all we have left is the 3 year swap contract. For a 3 year swap contract with fixed rate 4%, we assume annual fixed payments. Let us uh, assume that the principal is 100 units. The swap's fixed leg present value is equals to present value of all fixed coupons plus principal 100 discounted by DFs. So at par, the present value of the fixed leg should be equal to 100. And if the fixed payment for each year is 4%, then the coupons which we get for each year will be 4% of 100, which will be equal to 4. So from this, we can write this as 100 should be equal to 4 into TF of 1 year plus 4 into TF of 2 years plus 104 into TF of 3 years. We bootstrap the values of the discount factors of 1 year and 2 years, which we got from the 1 year government bond and 2 year government bond into these. And we find the value of discount factor for 3 years. Doing this, we get discount factor for 3 years will be equal to 0.8847 approximately. We already know the zero rate formula. So the zero rate R for 3 years will be equal to 1 by TF of 3 years by 1 to the power of 3 minus 1, which will be equal to 1 by 0.08847 to the power of 3 minus 1. Now, if we calculate this, we'll get an approximate value of 4.19%. So the zero rate for the 3 year swap contract is 4.19%. Now, the interest rate is nothing but a curve, taking the zero rates in the y-axis and the maturities in the x-axis. So if you plot using this data, we get a curve something like this. This is the zero rate curve which we get from the data. So what did we learn from the interest rate curve we just built? Short-term rates are quite high. This tells us that right now, borrowing money for a short time is expensive, probably because central banks have raised interest rates or there is less money in the system. Around 1 year, rates go down. This means that market thinks interest rates might fall soon, maybe because the economy could slow down or the central bank might cut out rates. For long term, which is 2 to 3 years, the rates go up again. This shows that investors want a bit more return if they're going to lock in their money for a longer time. That's often because of the uncertainty, inflation risk, or possible rate increase in the future. How can we use this information? Borrowers might want Borrowers might wait before taking long-term loans if they expect rates to drop soon. Investors could see a drop in medium rates as a sign to lock in slightly better yields before they go lower. Policy watchers would note that the market is expecting rates to cut soon, but not permanent. Rates might rise again. So, to conclude, a yield curve is more than just a line. It's like a map of market thoughts about the future. By reading it, you can get clues about where interest rates, the economy, and even the inflation might be headed. Thank you.